Today, we're diving into one of the most important, and honestly, one of the most overlooked concepts in investing: liquidity.
So let's start with a really direct question. Imagine an emergency pops up, or maybe a golden opportunity you just can't miss. If you needed your money, like tomorrow, could you actually get it? The answer to that question? Well, that's all about liquidity. All right, so let's break this down. What exactly is liquidity? Well, at its very core, it's about your power to get your hands on your cash right when you need it.
Now, the official definition has two parts, and both of them are absolutely critical. First, how easily, which really just means how quickly, can you turn something you own into cash? And second, can you do it without having to sell it for way less than it's actually worth? You see, both pieces of that puzzle have to fit, because speed doesn't mean a thing if you're forced to take a huge loss just to get out.
You know, a great way to think about this is with a simple water analogy. Think of some of your investments as frozen solid, like a block of ice. That's your real estate. Selling a house can take months. Others are more like cracked ice. They're less liquid, but you can move them. That's kind of like your stocks, which you can usually sell in just a few minutes on a trading day. And then, of course, you have pure liquid cash, the most accessible thing of all.
So we know what it is, but why should you care? Well, it's because liquidity is your financial flexibility in a world that, let's face it, is always changing.
It really all boils down to one word: flexibility. Having liquidity gives you options. It's the freedom to handle an unexpected bill without derailing your entire long-term plan, and it's the agility you need to jump on a great investment opportunity before it disappears.
Let's look at a side-by-side comparison here. If you own stocks in a big company, you can pretty much sell them within minutes during market hours, right at the going price. It's fast, it's flexible. But compare that to an illiquid asset like a piece of property. That process can drag on for months. It involves a ton of back and forth negotiations, and that final price, it isn't locked in until the very end.
And this is so important. In a market downturn, illiquid assets can literally trap your money. When everyone is rushing for the exits and trying to sell, it can be almost impossible to find a buyer for something like a piece of art or a share in a private business, at least not without taking a massive hit on the price.
Now, it's really important to get this. Liquidity isn't just a simple on or off switch. Nope, it's a whole spectrum, and not all assets are created equal.
This right here illustrates one of the fundamental trade-offs in all of investing. Generally speaking, the more liquid an asset is, the lower its potential return might be. So to chase those higher returns, investors often have to accept that their money's going to be tied up for longer and it'll be harder to get to. It's a strategic balance, really, a dance between risk and reward.
Okay, let's map this out so it's crystal clear. On one end of the spectrum, cash is king. It doesn't get any more liquid than that. Next up, you've got things like high-quality bonds, then stocks of large companies. As we move further down the line, you hit real estate. And then way at the other end, the far end, are things like private equity or rare collectibles, assets that could take months or even years to turn back into cash.
So, the big question is, how do you actually apply this? Well, it's all about creating the right balance of liquidity inside your own investment portfolio.
A really well-diversified portfolio doesn't put all its eggs in one basket, right? It's designed to hold a portion in highly liquid assets, like cash or bonds, to cover any short-term needs. Meanwhile, the majority is in those long-term holdings that are aiming for growth. Of course, the exact mix is always going to depend on your own personal goals and your timeline.
So why does this balance matter so much? Well, because it allows you to handle an emergency without being forced to sell your stocks when the market is down. It lets you jump on new opportunities when they appear. It helps you manage your overall risk, and ultimately, it helps you stick to your long-term financial plan without getting knocked off course by life's little surprises.
So the key takeaway here is pretty simple. Liquidity is your ability to move. The more liquid your portfolio is, the more flexible, and frankly, the more resilient you are as an investor.
We'll leave you with just one final thought to chew on when it comes to your own investments. How quickly could your portfolio adapt to the unexpected?
Learn, invest, repeat. Investing made understandable.